We're back with the final Dunham Quarterly Snapshot of 2023. At the end of every quarter, we give you our insights on global markets and the economy, all summed up in a few minutes. Now here is a member of Team Dunham to take it away.
On the equity market front, it was a big rebound from the third quarter with the US S&P 500 up 11.68%. Meanwhile, interest rates on the long end of the curve have dived, with a 10-year treasury yield at 3.88% now versus 4.98% on October 19 of 2023, which marked the peak of the 10-year. So what's fueled this rally? Well, it appears that the rising interest rate expectations are over, and even the Federal Reserve is now projecting 3 interest rate cuts by the end of 2024. Meanwhile, the U.S. Treasury ran a $1.7 trillion deficit in fiscal year 2023, an increase of $320 billion from the previous fiscal year. The government spending has likely helped growth and liquidity going. This has created a conundrum between the Federal Reserve and the U.S. Treasury. The Fed has tightened monetary policy while the U.S. Treasury has eased through some spending. Imagine a car that's both stepping on the gas and brakes at the same time. But with the Fed signaling rate cuts, this has taken the heel off of the market's neck, implying a rotation from risk off to risk on, in anticipation of cuts as both feet are now on the gas. So as market indices and bonds outperformed in Q4, the economy also continued to chug along, giving hope that the Federal Reserve has engineered the soft landing. But the big question remains, are cracks beginning to show? Well, as usual, the data tells a mixed story. For instance, Black Friday, while seeing a record $9.8 billion in online sales, which is up 7.5% year over year, also saw disappointing sales from a group of retailers that depend on Black Friday sales more than peers, marking a 4% decline. Meanwhile, many are paying through buy now, pay later plans, which is a form of revolving credit, with some estimates showing a 47% year-over-year rise, compared to just a 10% increase last year in 2022. To put this into perspective, the prior cycle, it took 12 years from between 2008 to 2020 for revolving credit to increase by $80 billion. But in the post-pandemic cycle, it took less than 4 years for consumer credit to grow $187 billion. Said another way, credit card debt has grown 7 times faster in this cycle than it did in the prior cycle. But on the bright side, the economy continues to show a robust labor market, which has held up reasonably well amid the Fed's aggressive tightening, as well as the declining inflation rate. Also, the price of oil has declined quite a bit this quarter, down roughly 16%, running up double digits in Q3.
Thank you, Dunham. We hope you enjoyed 2023 in our Dunham Quarterly Snapshot, and see you next quarter.
Please subscribe to our channel to stay up to date on the latest Dunham insights.